All right, so thanks everyone for joining today. Here to talk about the recap from the meeting that I went to earlier this week. It was revolving around the NIW company, and they're the ones who sponsor the product called Kaizen. And we walked away with a lot of really cool opportunities for you as agents for your top clients. And today we're going to focus on the agenda here. We'll talk about a little industry insight, some of the stuff that they talked about at the meeting, little tidbits here and there that could help you in your practice to sell either this strategy or, insurance in general. Some really good insight on the industry. We also will then talk about Kaizen. What is it? How does it work? And even some current stats, once again, to help you in your practice. And then lastly, some sales ideas revolving around gifting, more employee type retention strategies, as well as maybe a step alternative. So diving right in, we first want to look at the industry insight. So, what was stated at the meeting was based on what people are seeing in the industry. It looks like some of the economic conditions that we've been pushing through over the last, year, two, is looking like we'll see some reprieve or work in our favor in Q4 or early Q1 of 2024. But in perspective, some of the things for our industry that's actually good is economic uncertainty. Why? It starts to motivate people to think differently. When we talk about some of the solutions that we have today, they're alternative investment strategies. They're not meant to replace mutual funds, stocks, things like that, real estate, but they're meant to complement the overall strategy. And even with AG 49A revised, or I think some people call it AG 49B, really what we found now is that most carriers are really poised to do the under promise and over deliver. So a lot of the carriers now are showing lower rates. Their buyups or their multipliers or whatever are limited. So we have a better opportunity for expectation with the consumer. And on top of that, we think about the Kaizen product. It's actually designed conservatively as well. So we can have that better feeling for the consumer on the back end. The last thing we want to do is overpromise and underdeliver. I'm not going to get too technical, for example's sake, with this slide here. And I do apologize. So I was taking a lot of pictures and I was using them because there's a lot of good information from it. But when we look at the general account, that's where all the money goes from the insurance companies. When people put the premium in, all the money goes into the general account. And they talk about the spread. Now, most companies or the way the insurance carriers design it is they want a spread of about 2%. And that's what you see right here between the costs and the amount of money that's going into the general account. But over the last couple months, like last year, you'll see here that there was a big squeeze from the illustration standpoint. And the reason is that from the standpoint of what happened in the market with the interest rates is they went up too quickly. And so there's usually a lag when it comes to illustrations or increases in participation or cap rates when it comes to the insurance companies. So that's why, going back to what we said before, we should see some reprieve come Q3, Q4, excuse me, Q4 or Q1 of 2024. That should give us a wider margin, more opportunity for higher participation rates and cap rates, which is good for our consumers. And so when we think about what is Kaizen, Kaizen is a strategy. We want to think about how we talk about positioning. We don't want to be product pushers. we want to sell the story, and if the client likes it, then we bring in the illustration to go with it. And so Kaizen is a strategy. When we think about leverage and the idea of utilizing leverage, we can do that with our homes. So if I had $100,000 and I took that money and I bought $100,000 house, I own it outright. I don't owe the bank anything. However, it's probably a smaller house and I've got a family of four, so it might not be too comfortable. However, if I leveraged the bank, took a mortgage, and had the opportunity to buy a bigger house, what does that also do? It provides a stronger trajectory for equity growth because I'm buying a bigger and more profitable house from that standpoint for when I sell it someday. We think about cars. So if I had $10,000, I could buy a real basic plain vanilla car, gets me from point A to point B. But say I want that nice Tesla, maybe I could use the 10,000 down payment and then borrow the rest from the bank for a leverage strategy to give me something more advantageous. So if we think about that from those two, why can't we do that from a retirement strategy perspective? So when we talk to our customers, they may have already heard of something called premium finance. They might have heard of Kaizen, but what if you call it bank finance retirement strategies or a bank finance retirement solution? And the idea here is it's called 3-to-1 leverage. Whereas you see the participants and myself is these white pigs, and the bank financing is these blue pigs. Now, in the first 5 years, you'll notice that there's an even split between myself and the bank. So that's 1-to-1 or 50-50, if you will, between the two. But then in years 6 through 10, the bank picks up the tab for the entire premium. Now, this is where some people will say this is too good to be true. Why would they do that? Well, let's think about how banks make money. Banks make money by loaning money and collecting interest. So they're doing exactly what they do to make money. The insurance company is now winning because they're not getting small, target premium sales. They're getting super juiced up policies, so they have more money to invest as well. And the client wins because they're only paying a quarter of the total amount of money towards this type of strategy. So let's look at this in some real numbers, and we'll say 40-year-old male, average health, contributing $40,000. Now, in that scenario, once again, now the orange pigs are my contributions, green are the banks. You'll notice I put 200,000 in over 5 years. So even spread 40,000 for 5 years. The bank is contributing about $500,000 for a total combined of 733. But once again, my contribution is only 200K. And what I'll get is an initial death benefit of around 1.3 million, income from 65 to 90 of $112,000 tax-free for a total leveraged amount of about $2.9 million. And if I make it to 90, $800,000 death benefit passed on to my next generation. So the idea here is you're utilizing the bank to boost up that opportunity for growth. Before you're allowed to take money out, you have to pay the note back to the bank. And what do you use? Cash value from the life insurance accumulation to pay the bank back. So what's coming out of my pocket as a consumer is that $200,000, and the rest is being utilized by this type of product. Now, here's where it gets really interesting. Now, if you do a traditional premium finance route, where you have to go get a lender, you have to get the in-force illustrations years 2 through 15, you have to monitor it. Kaizen does all of that for you, but they also make it very clean for the consumer. And what do I mean by that? There's no loan documents. So we're not talking about going out and getting a mortgage on our life insurance policy. There's no personal guarantees. There's no credit checks. There is some form of financial underwriting, but it's not like what you think. So with certain carriers, all you have to do is show 2 years of W-2 or K-1 income, and you can qualify financially for a Kaizen plan. And so in traditional premium finance, what you'll find is a lot of the times you'll have what's called collateral. So if the premium for the policy is $500,000 and I only pay the interest, say it's $35,000 in the first year, there's a gap from what I borrowed to what I've put into it. Therefore, that gap has to go into collateral and sit in the bank as liquid asset. And so here, the collateral for these type of policies is the policy. So your consumer or your client doesn't have to give up additional assets. The only thing is they have to understand that it's a 15-year wait. You fund for 5, the bank does the other 5, so a total of 10. Then you let the policy cook for 5 years before the cash value pays off the loan. So unless you plan on taking money from the policy from your own personal checking account to pay off the loan, you can't touch this until the loan is paid off to the bank. So that's the only thing I like to just overemphasize from that standpoint. Now, some statistics behind this. You look at 10 years ago when Kaizen was born, so to speak. Uh, Thousands of clients have already purchased this. 10.8 million households with incomes above 200K need a type of solution. And NIW has paid premiums to date of almost $1 billion. And the big thing that I like about this is the persistency average is 96%. So that means you work with clients who have that full-blown commitment to put in the total premium for 5 years. And then you have 20% at a repurchase rate. So that means you finish your 5 years and you might start another one. So the bank is finishing up the first Kaizen for you as you start another one yourself. So there are people who will go for another 5 just to add that value proposition. And so what does the 1 billion in paid premium represent? Total death benefit currently issued at 6.7 billion and projected income of 5.5 trillion among all those policies for that 20-year span of income. So a lot of people have already done this. When you talk about substantiating it with facts and data, they've been around. They've done it with high interest rates. You think 10 years ago, they've done it with low interest rate environments too, like we saw a few years ago. So either way you shake it, this company has been around doing it. And again, apologize for the blurriness, but Grace Bernard, who actually created Kaizen, often shows her actual returns. And what you'll see here is she's still outperforming the typical illustration. Illustration now is about 6.4-ish, but she has 1, 2, and she knows for a fact she's going to get a third 0 this year, and the interest rate went up, and she still has a positive return from this strategy to still give her that full-blown leverage story. So needless to say, you can still win even in higher interest rates. Matter of fact, I think now is a better time than if you sold it 2 years ago when it was like 2.8%, because now you have to go back to your client and explain a 6% loan rate. And you can go back now efficiently or effectively and say to the client, listen, in the next 15 years, I can assure it's probably not going to stay this high. Gives you a better chance for getting the sale versus not. And when you think about that too, when you talk about interest rates in general, you have the opportunity. This doesn't even include the fact that higher pars and caps are on the way, as I mentioned. So we should be able to outpace this bank interest rate, no problem. So that's a little bit about the product itself. I can even show a demo of the website too. But what I want to get to is really some sales ideas when we think about this, because this is all fine and dandy, but how can you actually put it into practice? So when we think who is this gifting strategy for, we can think of parents or grandparents either looking to leave a legacy or setting their kids up the way that they want to, as opposed to maybe how they had it when they were first starting. And so we want to look at the idea of the current gifting amount for parents or grandparents. I have two kids, and my wife and we could technically gift to both our boys a total of $34,000 apiece. So my gift is 17,000, my wife's gift is 17, 34 for my oldest, and then 34 for my youngest. So those type of strategies are available, and I'll show you some of the parameters around that. Because if you think about the idea of a leveraged legacy to your kids or grandkids to set them up, you're talking about hundreds of thousands of dollars in tax-free income for them for their retirement. And then we'll talk briefly about adults who may have a lot of assets, but they're not liquid. So we want to think of estate planning. Maybe they're property rich, cash poor, not really cash poor per se, but you kind of get the idea here. So if we look at the idea for the qualifications for what I would say is normal gifting, so using that 17,000 per kid per parent, the gifter must show 200,000 of income per year or have a $3 million net worth, which can be substantiated through a personal financial statement from their CPA. The gifter must also have adequate death benefits. So I know when talking to a lot of people in the past, they would often say, I want to put $1 million policy because I want to stuff a ton of money on my 5-year-old because they're trying to take advantage of the cost of insurance. Well, there's rules in play for the insurance companies as to how much you can put on minors because people are trying to circumvent the cost of insurance. That's why the person receiving the gift must be 18 or older. So it's not meant for your 1-year-old. If you, as the giftor, are under age 55, you must have a Kaizen on yourself as well. So there was a strategy or a situation where they came up and explained where a father wanted to gift a Kaizen policy to his daughter who was getting married. And so they went through the process. He got his own plan, but he had it meant for death benefit focus, not for income. But he also got one for his 22-year-old daughter. And when they went through the math and everything, he was looking at about, or she was looking at about $322,000 a year in retirement income. And so then the father of the bride talked to the father of the groom and said, this is what I'm doing for my daughter. And then he bought a Kaizen and then he got one for his son as well for about $280,000 in retirement income. And they can use it for other things too. After that 15-year window is over, down payment on a house, investments, whatever, you can take loans out against that. But the idea is you want to give someone dish towels or new plates, or do you want to give them a legacy where they can get tax-free income? So it's a really great story on what you can do from that standpoint in gifting. And that rule for people under age 55 who are doing this type of plan, it's a good way to get another one in so your client, so you can really get two Kaizens at one time. But the other thing too is giftor must have adequate death benefit. So If I have $1 million and my son, who is now 18, I get him $1 million, that's not an adequate amount. Once again, the idea from that standpoint sounds like I'm trying to circumvent the rules, so to speak, and that'll probably get shut down by the carriers that qualified with NIW for the Kaizen strategy. So if you have any questions about that, please feel free to reach out to me. I'll gladly help you with that. And it's very easy to do it in the system because once again, you can do this through they call it ILIA or ILIA software, ILIA, and you can have it set up regarding gifting strategies. But I would always recommend when you do advanced stuff to include a cover letter so people know what you're doing. When we think about the wealthy, when we talk about estate planning, currently they may need the assets. They fear that if they leave funds, they won't be spent wisely, and they want their gifts to be meaningful. So, as opposed to doing a strategy where they basically give it to their kids and gift it to the kids, they might gift the monies to the trust and let the trust buy the insurance on them for true estate planning. So we can do premium finance for estate planning as well. So thinking in your head, what type of real estate people who might not have those assets readily available, but they can prove it through a personal financial statement, their net worth. We can also talk about doing something like that. Now, depending on how much they're worth, we might go back and forth and say, well, maybe they should just do regular premium or regular funding. But the whole idea is, once again, you have the story available if you need it. You talk about estate planning, and then they say that's too much. Say we can have leverage bank funding strategies as well and go down this road. If at any point in time you need help with that, that's what I'm here for. I'm here to help you guys grow and help you close those big cases out too. Now, a lot of key opportunities is in the small business market. When we think about employer or employee benefits, we think about key person insurance, and we look at small business owners, and they showed an interesting statistic that 99.6% of companies in the United States have less than 10 employees. So as you're talking to these type of owners, you ask them what would happen if one or two of your key employees quit? What would happen if one or two of these key employees passed away? More than likely, they're going to have a big concern. And then we think about employers looking for retirement plans. They're always looking for tax deductions. So one time, especially if it's a small organization like an army of one, they always look for like things like steps. Uh, so can we talk about a SEP or maybe a LERP, maybe a leverage LERP? So those are conversations we can always talk about. But when we think about like the transaction of a CEO or corporate owner wanting to provide benefits to an employee, why do they do that? It's not because they want to spend more money, they need help. And I'll give you a prime example. I, for example's sake, love going out, doing case design, meeting with people, point of sale. And then I'm thinking about, should I get an illustration design person? Should I get someone for L&C? Should I do all this other stuff? So sometimes you have to expand. And when doing so, how can you attract the top talent? And so solutions like this give you the idea where you can provide a story to help, get someone in, and retain them is the most important part. The worst thing is employee turnover. And if you provide a value proposition to these employees, they're more likely to stay. Now, also with this type of strategy, you're protecting against medical emergencies like living benefits, premature death, and retirement planning all in one spot. Now, when we talk about retention, 23% of millennials in the workforce plan on changing their job in the next 6 months. So you as a owner have to question, if you lost one of those key employees, how much is going to cost for recruiting, onboarding, the loss of productivity? Maybe customer service is diminished and errors start to happen. Yeah, training costs, all the knowledge that the prior person had. How are you going to bring someone in to repeat that, or be equal to or better? And how can you keep them due to future competition? So when you see the average cost when losing an employee, it's 100 to 150% of salary for technical positions, or 200% for C-suite positions. So when you think about that, if I, Phil Resch, own Valor Financial, and say, for example's sake, I have an employee, and I say, listen, Mr. Employee or Mrs. Employee, I need you for at least the next 5 years. If you stay for the next 5 years, I will give you a bonus strategy of $25,000 a year. Now, with this strategy, I'll bonus you the 25. We're going to put this into what's called a Kaizen plan, where the bank will match it and give you another 25,000 for 5 years, and then the bank will pay the rest for 6 through 10. How many people would love to hear that their company is going to give them a retirement vehicle with tax-free income, and a bank is going to match it for extra leverage? And then after that 5 years is over, if you want to re-up it and do another 5-year plan, you can do it. You just open up another Kaizen plan and keep that person on board, or you cut bait. If that person decides to quit or leave, then that's perfectly fine. You can stop the payments, and if the policy lapses, it's on that person due to loss of, not being able to fund the policy anymore. So it really is a win-win for you, because as an employer, you also have the ability to write off the premiums you're bonusing to the employee as a wage deduction. Now, where the write-offs don't work is if I, Phil Resch, owner of Valor, bonus myself money as an S corp. It's a pass-through entity, so I'm going to pay taxes on my personal versus my business, and it doesn't make sense. So what I would say is someone outside of the lineage, outside of your spouse, someone who is not dependent on your taxes. That's where that'll work. The last thing I'll mention is the SEP alternative, I would say. So if you think about it, like I have my CPA, my CPA said at the end of last year, Phil, you have a tax problem. I was like, okay, so what should I do? And she said, well, you could fund about $34,000 into a SEP plan, and you would get a deduction of about $5,000. Wasn't too appealing if you ask me. So when you think about these deductions or these people looking for SEP plans, if I took that 34,000 and instead put it into a Kaizen plan, and from there I get the bank leverage, I now have another 34,000 coming in from Kaizen, and I do that for 5 years. Now all of a sudden I'm building up a retirement plan, which if you think about it, some people will say, well, why would you do that? You get the deduction today. But we had examples shared, and there are a ton of pictures, but the big one is you look at the GDP. And when you look at the GDP, debt to GDP ratio, it crept up incredibly. And so all of a sudden they raised the taxes to knock the debt to GDP down. But if you see now, we're at a historic low, and look at our debt to GDP. So is it smarter for me to pay taxes today and not have to worry about them later? I'd like to think so. If I can complement that on top of the fact that it's leveraged assets, tax-free, now I have an even better story to go to my clients with, because this will not stay the same. we are going to have to raise taxes to control this giant monster we've created. And they talk about the asset or the debt ratio is over 31 trillion. Now, if you think about just $1 trillion, if you stack a dollar up and you keep going up, $1 trillion will get us to the sun. I think even in back. But needless to say, it's a lot of money, and that's just 1 trillion. Now, what they don't realize is the real national debt is about $155 trillion. We're the only country that allows for what they call official debt or stated amount of $31 trillion. So we have a lot of debt on our hands. And the only way the government can get that money back is if we as a country spend less or we start raising taxes. So with that, I'll kind of pause. I don't see any questions in the Q&A, but what I'll say is that this is something that we should be delivering to our consumers. And if you think about it, not everyone will qualify for Kaizen. However, even if they don't qualify for that, they love the story of tax-free income. If you deliver the story appropriately, people will see the value proposition of tax-free income, and they might buy a non-leverage or just a simple LIRP life insurance retirement plan. So I'm going to stop the recording here.